Welcome, and thank you for joining our first quarter CIO Perspectives webinar. My name is Matt Berger, Vice President here at Lincoln Financial on our Client Investment Strategies team. And today, we're going to tackle some of the top questions on the minds of investors as we head into 2025. And along the way, we'll provide you with resources from our client-approved Market Intel Exchange chartbook that you can begin using right away in conversations with your customers. You can access these slides in the Resources tab right here in the webinar. Now, we were told we couldn't call it a CIO Perspectives webinar without a CIO, so I am thrilled to introduce our very own Chief Investment Officer here at Lincoln Financial, Jason Bronchetti. Jason, welcome. Thanks for joining.
It's great to be here. Thanks for having me. I always have fun chatting with you, and your energy is contagious. So I'll do my best to try to match it. But thanks for having me. I'm really looking forward to this. Let's get into it.
Yeah, I'm excited to jump into it as well. But before we start looking forward to 2025, let's just take a moment to appreciate 2024, which I think we both agree was another incredible year for investors.
No doubt.
Yeah, in large part, it was a continuation of what we saw in 2023.
Yep.
Right, you had the economy that continued to answer every single question thrown its way. The Fed began easing, and we know cut rates by 100 basis points in total by the end of the year.
Yep.
And momentum, once again, ruled the day with this continued optimism about AI and tech really leading the S&P to a 25% gain for the year, which, by the way, was the first time that we saw back-to-back yearly gains of 20% or more since the late 90s.
Yeah, it has happened, but it's been a while.
It's been a while, that's right. So Jason, I'm going to start with the million-dollar question I think everybody wants to know, especially after a run like this. Can this really continue into 2025? And if I'm an investor, what should I expect this year? Perhaps another 20%?
I don't know. Another 20% gain may be ambitious, but I am optimistic that we'll see more growth in 2025. Even though we do expect it to come with a few more rough patches, maybe even a correction along the way. I think there's a couple different ways that I'd look at this. Have if you look back historically, being up 20% in back-to-back years isn't a reason by itself to be bearish. We have a decent slide on this. Maybe we can pull that up. Yeah, here we go. Okay, so in this slide, we went back to 1950, and we found 8 other times that the S&P 500 gained 20% or more in consecutive years, the most recent being in the late 1990s. And in 6 of those 8 instances, as you can see, the stocks were higher the following year. And they had an average gain of more than 12%. So there is some historical context for what we're seeing right now and to be optimistic. That's it. I think more importantly, I think you need to consider the macro backdrop heading into 2025, which overall looks fairly constructive still. The economy is in good shape. We have strong labor market. We have a healthy consumer that's spending, and that's driving top line growth. We've also put some of that election uncertainty behind us. And then putting politics aside, I do think it's worth noting that the incoming administration is generally regarded as one that's expected to be supportive of equity markets. And then last, despite the more hawkish tone we've seen from the Fed in December and so far early this year, I think the reality is we're still in the midst of a rate cutting cycle. And historically, non-recessionary cutting cycles have really been pretty bullish for equity markets. And then, don't forget cash. There's nearly $7 trillion on the sidelines that could be available to buy any dips.
It's a lot of dry powder. And I think it's a really interesting point, too, about the cash. There's a lot of mixed views out there. Is this going to really flow into stocks? Is it not? I tend to agree that it has the potential, at least, to be supportive of any weakness.
Yeah, well, you're the perma bull.
Sometimes. Look, the way I look at it, and I'm part of this, right? We've got this entire generation of investors who, over the last 15 years, let's face it, we've been rewarded for aggressively buying any dip. So I certainly think that could have an impact.
Yep.
I do want to go back to your comment, though, about equity market performance during cutting cycles, because one of the most common questions we get from our customers. First, though, quick little rapid fire question for you, because this was one of the most popular questions submitted by the audience. How many rate cuts are we going to get this year, Jason?
Oh, man. Look, I think 2 is probably the right number, at least based on the current data. I hate making predictions, but I think that's probably the right.
That's pretty much consensus, right? In line with the Fed and the market.
Prediction.
Yep. So what do you, if you think about it, right? The Fed's firmly at 2, the market's one?
Closer to 1.
Yeah, closer to 1.5, maybe just short of 2.
Yep. Yeah, I mean, look, if you asked me 3 months ago, I would have probably said 4, but the picture has changed. I mean, there's no doubt. I mean, the economy is continuing to chug along at a healthy pace. And then there is some concern, I think rightly so, that inflation may be a little bit stickier than expected.
Okay, I'm going to be a little unfair here. Let's say I had a crystal ball. I can tell you right now you're wrong. Right?
Sure you can. Yeah.
2 is not the number, right?
Okay.
Now, if you knew that, would you say it's going to be more cuts or fewer cuts?
No, really putting me on the spot. I would probably say more. I mean, I think high level, I do believe that inflation will continue to drift lower. I mean, the comps are going to get easier, even if we see some hot prints along the way. And I think the Fed, despite talking the market kind of down recently, I think the Fed has a bias toward getting rates back down to neutral. I mean, it's debatable what that level truly is, but ultimately, as far as the implications for the economy, I think if we saw fewer cuts in the short run, I don't think that's necessarily going to be viewed overly negative for financial markets. It's kind of what's getting priced in now. So I think the real question is what would be driving the reason for fewer rate cuts? And if there were fewer, is it because there's a meaningful resurgence in inflation? I mean, that would be pretty negative.
Yeah, I mean, look, a stronger than expected economy, I mean, that should benefit asset prices, right? Is that not what we've been seeing for the last 2 years now in an elevated rate environment?
Absolutely.
But that, like you said, that resurgence in inflation would definitely not be welcome.
Yeah.
Okay, speaking about the economy, I took a little bit of a detour there, as you saw, but let's go back to your comment.
All right.
Equity market performance during cutting cycles.
Okay.
And we have this great slide that I think really, really simply lays out some historical context.
Okay.
So if we can pull that up here, great.
There you go.
Thank you. Got it. So this shows performance of the S&P during previous rate cutting cycles.
Yep.
And as you can see, spoiler alert, stocks have held up pretty well, right? Mid-high single-digit returns on average 12 months after that initial cut. But you alluded to this a moment ago. We did find a pretty big difference in outcomes based on the state of the economy. Can you touch on that a little bit? Because I do think that's a really important point as we think about discussions with customers.
Yeah, I mean, I think this is key. So what we found in our research, and you see that here, is that how stocks perform in the short run after rate cuts typically comes down to whether the economy enters a recession or not. And you can see that here in these slides. I think when the economy's managed to steer clear of a recession, stocks saw a significant upside, nearly 20% in the 12 months following that initial cut. And when you compare that to about a 3% loss in cycles that coincided with recession, I think that really helps to highlight why this strong macro backdrop that we were just talking about is so important to this constructive short-term outlook. And one other interesting takeaway, I think, from this, based on our current situation, is that, look, we're 3 months into this cycle and stocks had already gained nearly 5%. So I think to this point, the market is very much in line with what we typically see in these non-recessionary cycles.
I think this is also worth noting because, we are optimists here, right? If you stretch that time frame out to 3 and 5 years post-cut,
Yep.
returns have been positive on average, regardless of whether a recession created some of that short-term noise or not.
Yeah,
so
absolutely.
I think that visual that we just saw a moment ago, it really helps clients stay focused on the long term.
Yep.
I'm going to be a contrarian for a second, though.
Okay.
I'm going to be the best bear impression,
bear
the best
you can
bear
be?
I can be.
I don't
That's
know if you can
difficult
do
for
it,
me,
yeah.
right? I think the bears would listen to all of this positivity, and they'd immediately say, you know what, we're due for a pullback. And then they'd go on to list, all the factors, the usual suspects like stretched valuations, extreme concentration in indices,
Yep.
and really create this comparison to the type of conditions we had in that lead up to the dot-com bubble. I think it's a conversation right now.
That,
we hear that, yeah. So I'm curious your thoughts on that. I mean, do you believe a bubble is brewing entering 2025?
Well, first off, I mean, I wouldn't be surprised at all if we saw a meaningful double-digit drawdown at some point in 2025. I mean, as a matter of fact, I'd fully expect it. I mean, and that's not a prediction. That's just looking at what's happened through history and thinking about the probabilities
the time,
thereof.
right?
Yeah, right?
Yeah.
So now, relative to your question about the dot-com bubble, the S&P 500 is certainly trading at a material premium to that long-term average, and that's something we need to respect and be aware of as investors. But I don't believe that necessarily says that we're in a bubble. I mean, you could definitely find similarities in the market concentration, perhaps, to the dot-com era, but a big difference that gets lost in those comparisons when people are talking about that, today's market leaders, namely the Mag 7, they're incredibly profitable businesses with sizable moats. So to some extent, this justifies their more lofty valuations, which, by the way, are still much lower than the dot-com peak when many of those companies were just really unprofitable startups. So, eventually, though, it's likely something will give. I think it's very possible that returns over the next decade could be lower than the previous decade. But as we've seen in the past, momentum is one of the strongest forces in investing. So I think it's best to stick to your long-term plan and really not time the market.
All right, yeah. I get it. Long-term investing, we've been well documented here. I tend to be a bull, but if I'm in the camp that something starts to give in 2025, this is the year. It's finally going to happen, right? How should I think as an investor? How should I think about positioning my portfolio to maybe capitalize on that a little bit?
Well, I wouldn't upend, your long-term plans, but there could be some opportunities to rebalance. I think to diversify into some of the unloved parts of the market that have been left behind, really for much of the cycle. What do you
mean by that?
Think about like value stocks, small cap, international. Those are all at historic discounts relative to the S&P 500, and so I think that those may represent attractive entry points, especially for longer-term investors. That's not our base case, but for those who truly believe this is like that dot-com bubble all over again or something, and think that we're set for another kind of lost decade like the one we saw from 2000 to 2009, I think there's some compelling reasons to think now could be a good time to diversify a little bit.
Can you give some specific examples? Like, when you say diversify, just within equity, let's say, right? What do you mean by that?
Yeah, so for that lost decade period, 2000, 2009, the S&P 500 fell, I think it was 10% cumulatively over that period. Right? So if you think about that from kind of beginning to end, and I think that part of the story is pretty well documented, and that's what we've been hearing from folks. But what doesn't get talked about much, this is so important, and it's particularly important right now, is that during that period, all U.S. stocks didn't do poorly. There were some pockets that really did pretty well. If you look back at the equally weighted S&P 500, that gained something like 65% during that lost decade. And both small caps, mid caps outperformed their cap weighted S&P 500 by 50% or more.
That's tremendous.
Yeah. So, even during one of the worst periods in modern times for U.S. stocks, there were still pockets of opportunities for investors.
That's so interesting. And I think really you don't hear about that a lot, right? Because you just hear about how bad it was. What about fixed income, though? Because let's face it, it's been, let's just call it a tough several years, and really last decade for bond investors. Tough might be generous.
Depends on your perspective.
That's right.
I get it.
Given that your team's role in large part is management of Lincoln's general account, I think you are uniquely qualified to comment on this particular question. What would you say to someone who's just had it? They had enough. They're about ready to just throw up their hands and just give up on bonds altogether.
Yeah, this is a great point. Look, we haven't really touched on bonds yet, and as you said, that's really what my team is primarily focused on. So I'll try to put that general account hat on. And it has been a rough go from a total return perspective. But in my opinion, I think this is an incredible time certainly for institutional yield-oriented investors like Lincoln, like our general account. But I also think it's a good time for individual investors to add income to their portfolios, whether that be via contributions or rebalancing to your point about diversification. So, credit spreads are at historical tights. There's no denying that. But all-in yields are still elevated. We've seen them going higher lately, considerably, certainly in the back end. And while we have seen a bit of a modest increase in default rates among the riskiest borrowers, corporate balance sheets generally remain healthy. So I think it's a great time to earn some carry and lock in today's higher rates, even if that comes with a fair amount of rate vol and potential for price movements. The yield component is fantastic at the moment.
Yeah, I agree. You know what? I empathize. I do. Let me just say I empathize with this hypothetical person who's about to give up, because it has been brutal, right? Yeah. Especially relative to equity. But the way I try to think about it and put it into perspective is this, is if you liked the role of bonds in portfolio construction, call it a decade ago, the reality is you should love them today at higher rates. Do you agree with that?
No doubt. Yeah.
So probably not a bad time to do a portfolio checkup. Maybe consider some of these opportunities to rebalance. Jason, we've been pretty optimistic to this point. Probably because I'm the one able to ask the questions here. So I do want to get your opinion on what could go wrong here. So where do you see some of the biggest risks for markets as we head through 2025 here?
Yeah, I mean, there's always risks out there. I think at the moment, one of the biggest risks, and I think it's one of the most complex, is geopolitical.
Yeah.
It's always kind of there, but it's not to the degree that it is right now. I mean, we're seeing a range of global events, conflicts, things that seem like maybe they're isolated, but actually, interconnect and create really a bigger risk that kind of amplify that correlated risk. And the fact is, we're now in this era of this heightened global power competition geopolitically. I mean, for decades, the U.S. was the dominant global power. We know that. Today, I mean, the power is at least a little bit more evenly distributed between the U.S. and China, the EU, Middle East, others. And each of these players has, as we all know, different views on economic freedoms and respect for their neighbors' sovereignty even. And so I think that this shift creates a dynamic in the global order which makes it nearly impossible to predict and model economically. But it's crucial to consider that and to just to have more focus, perhaps put a little more weight in that tail risk than we would have in prior decades.
Yeah, I agree. I mean, you call that a secular theme,
Sure.
right? That
Yeah.
that it maybe isn't getting the attention it deserves right now, but
Yeah.
maybe that's because, absent some sort of acute escalation, it's something that'll likely take a little bit of time to truly play out and get some clarity on in financial markets.
Yeah. Until it happens.
That's right. Yeah.
Yeah.
But I want to ask, what do you think? Like, let's bring it a little bit more to the present here, like kind of what's right in front of us. What do you think market participants are focused on, right now in the more immediate future as it pertains to these various risks?
Yeah, sure. I mean, so these are somewhat related, but three things that I've got in mind right now is corporate earnings and whether or not they can live up to the lofty expectations.
They have been lofty.
Yeah. The second would be just uncertainty around policy with the incoming administration, specifically tariffs and immigration, which we know and get a lot of press. And then the third is just this potential resurgence in inflation. So if I think about those three things, I take a step back. You could make an argument that markets are priced for perfection heading into the year. Right now, all of those things are presumably priced in. An acceleration in earnings growth, robust economic growth, and very little easing to go along with it. As we mentioned, maybe two cuts, 1.5 cuts, who knows? So, I mean, don't get me wrong, things can absolutely shake out like this. But it does make markets a bit more susceptible to a growth scare because I think any small stumble could be viewed as a reason to sell off. So let's say, for example, we have an earnings letdown, especially with one of the top names like NVIDIA, or that reacceleration of inflation that leads to cuts being priced out or perhaps even hikes being priced in. And to be clear, neither of those are, that's not our base case, but I'm just, hypothetically, if those things were to happen, I think absent any policy shocks, I do see inflation as being relatively stable at worst for this year, but there either are certainly possible and could lead to a quick repricing of assets if we see that reaccelerate.
You mentioned the possibility of policy shocks there, right? That's another topic that we get quite a few questions about. And rightfully so, right? We've got a new administration coming in and potential shift in policy that many speculate could have a significant impact on both markets and the economy.
Yeah.
Curious, what are you hearing in your conversation with industry peers as to really how President Trump's second term could play out a bit as it pertains to markets?
Yeah, I think purely from a financial market standpoint, the administration is likely to do everything in its power to support asset prices. I hinted at this earlier, but in Trump's previous term, he all but used the S&P 500 as somewhat of a scorecard as to how the administration was performing. And like since the election, the positives are really what markets have been mostly focused on, kind of front running some of the potential tailwinds like tax cuts for both individuals and businesses, and certainly an environment with looser regulation, more M&A, just more capital market activity. But there are still some big unknowns at this point that could have major implications for the economy, namely tariffs and immigration policy. Maybe some of that's softening a little bit. But I think most of that's been largely ignored by market participants to this point, like maybe because they feel like it's not real, but it's still out there.
Let's dig into that tariff issue, right? I think that's another biggie. And also I want to take a little sidebar here because I think there's a lot of misunderstanding out there about how they work, how tariffs work on a fundamental level.
Yeah.
So what I mean by that is think about just as simple as who pays for what and when.
Yeah. Well, and you guys did a great chart on this in the Market Intel Exchange.
Thank you. Yeah. So the team did a fantastic job putting this together. We're going to pull it up here. I don't think we'll pull it up here, but We did create this new chart in Market Intel Exchange. It's on page 15 for folks who have that document pulled up and want to take a look at it. But it's just a very simple, client-friendly infographic that I think acts as a bit of a tariffs 101.
Yeah,
So the suggestion I would have is for everyone to check it out. Feel free to use that to implement that in your conversations to help really educate and level set. That said, Trump has been very, very openly and quite loudly floating the idea of broad, sweeping tariffs, most specifically recently targeting China, Mexico, Canada, for example. You mentioned in your previous comment there that this rhetoric has been mostly ignored by markets to this point. Why do you think that's the case?
Yeah, I think there's a couple reasons. I think first, markets tend to react in the short run to the most immediate threat. So tariffs may very well become a big story impacting asset prices as we get deeper into 2025. But for now, investors have mostly focused on the usual suspects like earnings, inflation, what's going on with the Fed, which for the most part have been fairly constructive. The second thing I think is I think there's still some doubt as to what the end game is with the tariff talk. We're seeing a little bit of this, a little bit of walking back perhaps. And I do think that there's a strong feeling amongst many that at least some degree of this is saber rattling that's being used primarily as a negotiation tactic. And there may be some truth to that. But a scenario, and this is purely hypothetical, that you could see happening, if in fact tariffs are enacted as proposed, it could go something like this, right? You get broad tariffs get implemented, sparks that retaliation from other countries, and then this not only slows down trade, leads to a weaker growth, it also increases the cost of goods for American consumers. So in this hypothetical scenario, you've got inflation up, the economy is weakening, and we're likely to see along with that, hiring weakness, rise in unemployment, et cetera. So that's kind of how that.
I'm
could
sure
play
that would
out.
definitely spook markets a little bit, right?
Yeah, I think so. Yeah, I think that would be, almost certainly I would put pressure on stocks. I think the flip side to this, and I mentioned this earlier, is the fact that this administration is likely to be supportive of equities. I think that could be a mitigating factor to some degree. The Fed obviously has dry powder as well. So, I'd say tariffs cause some negative sentiment to bleed into the market. I think the White House may feel some pressure to reassess if policy is truly serving their cause, and go a different direction. But look, at the end of the day, nobody truly knows how this issue is going to shake out. I think the most likely scenario, though, seems to be somewhere in between, where new tariffs are added, but not nearly to the extent or the magnitude of what's being discussed at the moment. And if you remember, there were many of these same fears following the red wave in 2016, and in the long run, it was mostly short-lived, and longer-term investors were ultimately rewarded.
All right, Jason, we have time for one last question,
Okay.
and I think this one is really in the spirit of providing client-friendly resources that our audience can walk away with today. Right, we want that to happen, and immediately begin using in their conversations.
Okay.
So I want to ask you for a moment to kind of put yourself in the shoes of the financial professionals who choose to do business with Lincoln. So you're a financial professional.
All right.
If you could carry only one page from our Market Intel Exchange, the entire thing, one page with you in 2025, and you believe this is the one that will add the most value to your client conversation, which would it be?
All right. Well, they're all so good, but if I have
I agree,
to
and
pick
the team
one,
will love to hear that too, by the
they're
way.
excellent. So kudos to the team. But one of my favorites is page 30. Maybe we can pull that up. There it is. Okay. And the reason I like this slide so much is that I think it can help prepare investors for volatility in the short run, but at the same time, it frames the importance of having a longer term outlook. Because look, talking about the outlook for 2025 is interesting, and it's definitely important because we know investors are going to ask financial professionals about these things, and they're going to expect them to have an opinion. But I think in the reality, most of us are best served by tuning out that noise, right? Just tune that out and focus on your long-term
Totally
goals,
agree, yeah.
right? So I think if I look at this slide, here's how I would do it if I was a financial professional. So the left side of the page, it shows the percentage of calendar years with max drawdowns of 5%, 10%, 15%, 20%, et cetera. And remember I said earlier, I mentioned I fully expect to see some meaningful drawdown at some point in 2025. And here's why, right? And 91% of the time, you're going to see a 5% correction or a
pretty
55%.
common,
Yeah,
right?
right. It happens all the time. So they're extremely common, and I think about drawdowns as a feature of investing, really not a defect. And more often than not, we see quick recovery. I mean, as a matter of fact, more than half of the calendar years that we've seen double-digit inter-year declines, but we still end up higher for the year. I mean, that's markets go up more often than they fall.
Yeah, I think the number is actually on here. I think it's actually 73%. 73% of years are positive.
No, there you go.
Yep.
Yeah, exactly. So, I mean, so what I found is that I think if you proactively share this when times are good, put investors in a frame of mind to not panic when that volatility does strike, right? And then on the right side, you can show them what happens to the growth of $10,000 over time. So this is looking at the growth of $10,000 investment in the S&P 500. And I think this really helps investors. Like, let's zoom out, let's see the big picture. And I think what makes this slide a little different though, and what I really like about it, is that we've overlaid not only like the worrisome events caused that were there for like short-term disruptions, but we also put in these charts the types of examples of American innovation over time. Things like the first PC, artificial intelligence, things that have had major impacts and been a major factor in not only shaping the modern economy and driving productivity, but also just driving markets higher.
Yeah, I love that. That's kind of unique for this type of chart. I've seen several of these, but not with that perspective.
Yeah,
I think you bring up an important point though about specifically using this proactively.
Yep.
Right. Don't wait for volatility to strike. Make sure that clients are, for lack of better terms, expecting it to strike, right?
Yeah, prepare.
Yeah, I think I've got a good analogy. I want to see what you think about this.
Right.
I think of it like this. When you're flying,
Okay.
if you hit unexpected severe turbulence, think bad turbulence, right?
Yeah.
You take a look
felt it.
around at people's faces. They're worried,
Yeah.
right?
Yeah,
Now, if the pilot then gets on reactively, and I think it's the key word, reactively,
Okay.
and he tells everyone, hey, look, don't worry about it. Completely normal. We'll be out of it in a bit. Look around a little bit calmer, right? Helps them down.
Yeah.
But you know what helps even more?
What's that?
Right. When they tell passengers ahead of time. How about that, right? We're likely to hit some turbulence. Now we're all expecting it.
Sure.
And again, think about it. When this hits, because it does, look around. Not nearly as many shocked or concerned faces.
Yeah, that's a great analogy. I've definitely been on both sides of that too, so it feels very personal.
Yeah, I think
that's a good one.
We all have. So Jason, we've come to the end of our time here. I want to thank you so much.
Thank
for
you. This has
joining
been
us.
great.
Thank you. It's just tremendous insights, great resources that our financial professionals can bring into their client conversations here in the new year.
Excellent.
And a big thank you as well to everyone who joined. Now, as a reminder, if you'd like to share any of the visuals that we discussed today with your clients, you can find them all in our Market Intel Exchange. Be sure to access it right here in the Resources tab, right within the webinar, or you can reach out directly to your link in contact to get a copy. Thanks again, and be sure to tune in next quarter.